Hey, this is Paul Barrett. I want to talk a little bit about investment principles. Just the concepts that you should understand before you invest a dime. You should understand some basic principles and concepts. And they're not that hard. I teach them in a financial wisdom seminar and I go into more detail. And in my Investing Wisely seminar, I spend a lot more time on them. But these are just basic ideas, basic concepts, basic principles, and you really should understand them. Before you invest a penny, you should understand these basic concepts, basic principles. Okay, now what I've found is even sophisticated investors, guys that are very wealthy, sometimes they don't even follow these things. I mean, actually, I'd say a lot of times they don't follow them. I mean, I've worked on portfolios. Even recently, I worked on a $6 million portfolio to help out, and they didn't follow even the basics of basics. Now, this happens all the time, and it also happened, and they also had financial investment advisors, and the advisors made mistakes, and the advisors didn't even try to correct them because the client was trying to push in a certain way, so they just took the money and invested and made their big giant commissions and their fees and their management fees. And as long as the investor didn't know any better, everything was well and everything was okay until the investor found out that they were exposed to an inexorbitant amount of risk. So I just want to go over a couple of these basic principles that, like I said, before you invest a dime, you should understand these completely. Okay, the number one principle, and I know you've heard this, is called diversification. Diversification is something you have to do, you have to understand. You know, it's a must for designing portfolio. It's a must before you invest your money. Okay, the other thing I think you should understand is called risk. You should understand that for every investment there's a certain type of risk, and for every type of economic condition there's a certain type of risk. You have to understand risks. For example, if you have bonds, bonds are prone to interest rate risk as well as inflation. So you're going to have another type of asset to balance your portfolio in the event that interest rates are driven up or inflation is driven up. And that's how you kind of understand that, like I said, every economic condition has certain risks as well as every investment. And you try to balance the risks. So before you invest, you have to understand the types of risks and how to balance a portfolio to protect against these risks. All right, and now the third thing I think you should understand is asset allocation. And asset allocation is the method that we use to help diversify your portfolio and to balance those risks. It's called asset allocation. And think of it as a pie, and maybe I'll put up a graph if I get time. And you break it into sectors, basic sectors. All right, most investments are driven off of stocks, bonds, and real estate. These are primary categories. And then we can add an international. And then we could also add precious metals. So just to keep it simple, think of these 5 sectors, think of a pie and how you divide that pie into these 5 sectors. And there's a little more to it, but I'm trying to make this real basic, real simple, so that you don't start just throwing money into one direction. I know a lot of people are pumping all their money into gold. Well, just like the real estate market, it was predictable that, that as it heats up, it's going to turn into a bubble, and eventually the bubble is going to burst. Real estate could not possibly keep rising indefinitely. It had a burst. It was a bubble. Well, the same with gold. At some point, the gold bubble will burst. It's hard to predict where that will be. We've reached an all-time high, but it could happen. So if you put all your money in gold, you're just setting yourself up for disaster. And that's why we design and diversify and design a portfolio and have these different asset allocation classes. So this is pretty simple, pretty basic stuff, but these basics can help guide you and protect you. Now, one other area I want to talk about, and your goals and objectives. See, your portfolio should be designed along those parameters that I just mentioned, the diversification, your risk, and the asset allocation, but it should also take into effect your goals and objectives. What are your goals? What are your objectives? It should also take the picture as to your age and your financial condition and your earnings level, because that ties into taxes. So all these goals and objectives and these principles tie into your portfolio design. It sounds difficult, but it's very simple for most people. It's so easy. I hate to say that a caveman could do it, but it's very simple. Now, so you tie your goals and objectives. If your goal is a retirement and you're 5 years from retirement, your asset allocation is going to be slightly different from somebody that's 40 years from retirement. So you just have to set your goals and parameters. I mean, you could have intermediate, short-term goals, long-term goals, and you design your portfolio to meet those specific goals and objectives that you set forth. All right, so that's about what I want to say. That's about what I want to say on this subject. Is before you invest a dime, understand these concepts and apply them to your portfolio. Don't just go randomly investing like a lot of people. A lot of people are day traders. They buy and sell on a daily basis, and that's gambling, and most of them lose. And even when they win, they don't win enough to really matter. You know, if you're playing with a couple $1,000s, and even if you make a good return for the year, that's nothing. We need to show you, if you know my program, my Financial Wisdom seminar, or my Financial Wisdom book, you'll know that you need to save, and you need to budget, and you need to put money into investments, and not a couple thousand. You need substantial amounts if you want to meet the goal. Now, the goals that we establish, general goals, are called financial independence or prosperity. We want to help you become financially independent. And so our goal is built on creating wealth and prospering. So it's a little different, but I just want you to keep in mind that before you invest a penny, before you make your specific stock or your investment selections, to have it all tie into a cohesive, well-balanced portfolio. All right, well, I'm not going to say too much more. I just want to give the heads up on this because I know there's a common error made, like I said, by even sophisticated investors. It's very common. And another thing, what really blows me away is when people who are certified financial planners, CPAs, attorneys, professional financial planners, when they make that mistake, in my eyes, that's fraudulent criminal action. But that's my opinion. But believe me, even the professionals make mistakes and do not adhere to these principles that I have just outlaid for you. Now, I'm not saying all of them, but there are professionals that fall into the trap of not following these basic concepts. All right, this is Paul Barrett. I want to say thank you very much. God bless you, and hope to see you in one of my seminars and to meet you personally. Thank you. God bless you.